Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. My name is Drew Benson. I'm the president and founder of Benson Wealth Management and a senior wealth advisor with my broker-dealer, Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm a trained economist and a certified financial planner. Now, today I interview the CEO and founder of Infineo, Cole Snell. So this is another two-part interview. In the first part of this interview with Cole, we spent a lot of time unpacking the nature of the business that is Infineo. Now, what they're doing is really revolutionary and unique. And after getting to know Cole and talking to him both before and after this podcast and during the podcast, what I've come to the determination of is that Cole is essentially creating a new asset class with life insurance. Now, if you think about most investments, whether it's stocks, bonds, mutual funds, there's securities that are tradable. And even things that weren't tradable, like mortgages. Mortgages, decades ago, were packaged together in what was known as a mortgage-backed security. And these mortgage-backed securities became tradable assets that could be sold on the open markets. Cole is actually doing something like that with life insurance, which I find really compelling. And they're not just doing it in traditional ways. They're actually using AI and blockchain technology to basically securitize life insurance contracts on secondary markets. I had never heard of anything like this before, and I'm presuming most of my listeners here have not heard of something like this. So today is merely an educational endeavor. I want you to understand the different types of financial innovation that's occurring in the economy right now. Now, I have to stress that, one, I do not buy or sell. I do not contract with Cole. I don't have a formal relationship with their investment products. So I want to stress that I'm not making a recommendation. This is merely educational. I appreciated Cole a ton for doing this. I think it's fascinating and exciting, but I do want to stress that I'm not making a recommendation for any of these products. I would encourage you to work with a trained professional financial advisor to give you guidance on if life insurance has an appropriate role within your overall financial plan. I hope you enjoyed today. Cole, welcome to the Benson Wealth Podcast. It's great to see you.
Thanks, Drew. Thanks for having me.
Yeah, no, this is an honor. So let's start with your business. Let's start with Infineo. Let's go back to basics here. What is Infineo and what are you trying to accomplish?
We're tokenizing life insurance, and the reason why life insurance is because through years of personal pain of trying to acquire as much life insurance as I can, because I recognize that it's a better version of fixed income. I felt a responsibility to democratize it and to get it into the hands of people around the world using AI and blockchain technology to help them have more certainty around money.
So you said a better version of fixed income. Unpack that for us.
Yeah, that's right. So I had an exit a number of years ago. I was in the food industry. I had an exit, and my financial advisor said, you have a problem. And I said, I know. I have too much money in my checking account at my bank, like Wells Fargo. And he said, I go, what do I do? You're my financial advisor. And this was before I was in the financial industry. And he said, put your money into life insurance. And I laughed. I thought it was a joke. And he goes, no, I'm serious. Go do the work. And he gave me some links and kind of pointed me to. So I went and I did the work on it. And I came up with 3 questions, which were too good to be true. Why are more people not doing it? And what's the government going to do? And they kind of shut down this loophole that I thought my financial advisor was kind of exploiting. Because it was very interesting. Because basically, you're putting your money, I'm hedging my money or my risk. Instead of putting it into traditional fixed income, I'm now sold on putting my money into life insurance. And I didn't look at my money as I didn't look at it as investing so much into life insurance. I looked at it as kind of holding my money in life insurance, using life insurance, as a bank. But then it was like a bank that had a yield on it that was over time 4 to 5% with very low, risk adjustment, very, very high Sharpe ratio, highly differentiated. And then, if my money's in life insurance, I mean, can there be a run on a life insurance company like you have a run on a bank? Well, the answer is no. So I'm not beholden to the $250,000 FDIC thresholds. And so it just kind of, made me feel really good about looking at life insurance either as a better version of fixed income, because, the 4 to 5 IRR, it's competitive right now with short-term debt, but we have an inverted yield curve essentially right now. But when that yield curve corrects, then that IRR goes way down. But then with life insurance, because the standard deviation in it is 1.2, then if I'm looking at Sharpe ratio, I'm going IRR minus standard deviation at 3.2. I'm going over time, yield curve inverted, uninverted. This is better fixed income, and I can also use it as a treasury. It's like, but then I was like, why are more people not doing this? Like, what am I missing? So I spent 2 years trying to figure out how my financial advisor was fooling me.
And there's, I'm curious. So, what was the specific life insurance instrument that you were using? Was it a whole life policy? Was it universal variable?
Yeah, whole life.
Okay.
Whole life, mutually owned companies. So I have policies in Canada and the United States. So my policies in Canada are with Equitable Life of Canada, Manulife, and Canada Life. I have 14 of them. And then I have in the United States Emeritus and Mass Mutual. But there's other companies that work well: Guardian, Lafayette, One America, Northwestern.
Yep.
Probably missing a couple, but they all work well.
Go ahead, Cole.
No, go.
Well, the interesting thing about them is they also do traditional asset management. Most of those companies, like Manulife, for instance, they own John Hancock, which does traditional bond fund strategies. And so I think a lot of the same managers that are managing these traditional public securitized market instruments, they're also managing the risk pools inside of these life insurance instruments that you're describing. So it's a lot of the same folks in general.
Yeah,
now,
completely.
The other component to life insurance that I always found interesting is the tax advantages. So if you look at, say, a traditional IRA, you put your money in, it's going to grow tax deferred. But every penny in a traditional IRA and a traditional 401k, at one point in your life, like you have to take that money out, or your descendants will take the money out and you will pay taxes. With an annuity, you also have tax deferral, but it has the same problem from a tax standpoint that upon removal, you pay taxes on that, right? And an annuity is a tough instrument. I'm not making blanket recommendations. I know I'm a wealth advisor here, but an annuity is a tough instrument to give to your loved ones because they inherit your basis in most instances. So that tax nightmare moves on in perpetuity, Cole.
Yeah.
But life insurance is really fascinating because you can actually remove your gains first, and then you can, in some instances, take a loan off of the principal amount. And in theory, it's not perfect, but in theory, there's significant tax advantages with life insurance. I don't know the backstory of why, but I do find that interesting. Is that a compelling component to life insurance for you? There's very different tax structure to it.
Yeah, and then your basis doesn't follow you. As you pass the asset along, the basis doesn't really, as long as it's leveraged through a bank or through a line of credit, the basis doesn't matter. It doesn't really factor in. So you're not going to have this, over time, this big grind down, adjusted cost based grind down that turns your asset into something taxable. So, yeah, I mean the life insurance in North America since 1847 has worked outside of the the Insolvency Act, and B, taxation. So it's been a tax not deferred but free vehicle since literally 1847 in North America. But then, how do you so you have this asset, you have this tool, this product, but how many people in North America understand how to use it? Well, it literally has been in the same iteration, say cash value whole life insurance, or whole life insurance with what would be a paid up addition rider. if you will,
Sure.
has existed in its exact iteration since 1847, and it hasn't changed. And it's been treated by through tax codes the exact same in the same way. Both in Canada and the United States and many countries around the world have universally just kind of said, well, sure, if this is the vehicle you choose to hold your wealth or manage risk or create some kind of legacy kind of strategy, financial legacy strategy, then you will be rewarded without paying tax kind of on it. But then how you work this thing is there's very few people that really understand the product, unfortunately.
That is very true, and I would say I think every people get so overwhelmed by the complexity of the traditional markets, like whether it's a hedge fund or private equity strategy or even stocks and bonds sometimes. But life insurance and other types of insurance products have extra layers of complexity that you have to add on top to it. And I think for the everyday investor, and it's not that they're not smart folks, but they're just so busy with their life they don't know about it. So what are potential investors missing in your estimation on what life insurance can do for them?
I mean, the first thing is finding an advisor or an agent that knows what the heck they're doing, and very few people do. I mean, the responsibility I think that the end user has today is to go and do the work, stay in the pain of it, like I did. I didn't come from the financial industry. 6 or 7 years ago, I barely even knew how a Roth IRA worked. I was in the food industry. I was moving inventory in and out of a warehouse. It was perishable. I had a lot of responsibility. I had a lot of trucks. My customers were Costco, Whole Foods, Walmart. They needed their food on time and with good dates. And that was my concern. It was when I sold that company and I moved into the financial industry where I realized I just don't know anything. So I just went and did the work, right? Okay. And that's what led me to life insurance. I just stayed in the pain, and I didn't go to school for it. I went to YouTube and I just learned on YouTube, and I learned from people like you, and I learned by asking questions and just being uncomfortable. And here I am now, a few years later, not knowing barely what a Roth IRA was to being a world expert because I studied. I went and read books, right? It's like not that complicated. So, what does the end user need to know? I mean, I just think I think fundamentally it's just understanding what opportunity cost is. Really understanding what opportunity. Most people that don't know what opportunity cost is, if it looked like a brick and was traveling 100 miles an hour and hit them in the head, because you just don't know what you don't know.
You don't.
Right? And so
you can't assess your options if you don't know what the options are.
Right.
And so a lot of people don't understand the various options at their disposal, and there's so much out there, and there's so much noise with different financial instruments that I think that's why the role of the wealth advisor, and clearly you had an awesome financial advisor that was guiding you. Yeah. It's our responsibility to help expose people to the different options, and then they can take it or leave it. But they at least need to know about it. And what I love about you, Cole, is you're just trying to expose people to other things and other opportunities that might make a huge material impact on their life and on their legacy and on their wealth.
Yeah. Yeah.
So let's get into Infineo, because I really want to understand this, because you're using blockchain, you're using AI. So let's start really simple. What is Infineo? What are you trying to do? And then let's talk about the technology underneath it, as if we're talking to a layman.
Sure. So Infineo is basically a tech company. We use AI and blockchain to essentially create ease and access to traditional financial vehicles, what were called RWAs, or real world assets, that would otherwise be difficult to acquire for the average person. And so nothing that we're doing is overly innovative. Essentially, we're taking technology that's kind of caught up to itself. So AI and blockchain, there's a company out of Singapore that was trying to do what we're doing now in 2017, and they really couldn't do it. And that was mostly because AI really wasn't there at all, and blockchain tokenomics really wasn't quite there where it is today. So today, AI and blockchain, like we didn't create AI or blockchain, we're just using stuff that other people already created. And then we're taking other assets, like real world assets, like life insurance, for example, and we're moving AI and blockchain together with life insurance to make people be able to give people the opportunity to use it in their life. The easiest way to think about it is as you would use fixed income. So the same reason that someone would buy a bond or a treasury or commercial paper or a hedge kind of thing in your portfolio, they would be able to buy this just as easily as you could go on to whatever marketplace you would buy a stock or a bond, and it would just be that easy to buy exposure to a different type of fixed income, but underneath it is life insurance, which is a better, in our economic modeling, I mean, the math tells us that it's a better version of fixed income. So
now, are you packaging life insurance then?
Yeah.
Yourself, and then they're buying the life insurance, and then you're able to create, like an income stream that you would see from, say, a bond portfolio or the private credit markets or other fixed income markets. Is that the gist?
Yeah. So we're going into the primary market, and we're buying life insurance policies, and we're essentially tranching them, rating them, and then redistributing them institutionally or even selling them at retail. Now, the retail market really isn't there quite yet. We're talking about security tokens. So you've heard BlackRock. BlackRock has been doing a lot. Larry Fink has been kind of taking it on himself almost personally to push this narrative forward, which is absolutely amazing. And then you have KKR, you have Hamilton Lane, Wisdom Tree. I mean, there's a bunch of big funds that have piled into what I call crypto in the daylight, or security tokenization of real world assets. And that's essentially what we do as well. So we buy these life insurance policies, and the place where we buy a lot of these life insurance policies is in the life insurance surrender market. So often life insurance is sold very, very poorly. Life insurance is very misrepresented, I would say. And so because of that, every year in America, there are $350 billion of life insurance policies surrendered back to the life insurance companies themselves.
Because they stop paying their premiums, basically? Is that
NSFs?
The deal?
That's all it is. Yeah, it's NSFs. And you get 1, 2, 3 NSFs, and the life insurance companies go, okay, well, you're not making your payment. We're going to cancel your policy. And so they
then you're buying them, right?
Yeah. And before the life insurance cancels the policy, we go out and we work with IMOs and brokers all over the United States. And we say, look, if your clients can't afford their policy, we'll buy it from them. And you've been able to buy these policies since 1911. A life insurance policy in America is property. In 1911, it was determined that this property should be able to be traded like any other property that you own. And we leverage that opportunity, and we go in and help the life insurance companies by keeping these premium dollars flowing on their books. And we also help the person surrendering the policy, because they get money back for the thing they can't afford. Plus, and this is very important, they get to keep retained death benefit. We actually give them a certain percentage of the death benefit, because we're not interested in the death benefit. What we do not do are life settlements. What we do not do are viaticals.
Okay. That was my next question.
That's where a lot of people, it sounds like that's what we're doing. That's not what we're doing.
Yeah.
At all. Now, we give people, we love people, because we're interested in the cash component. We're interested in the accumulated growth in the yield by paying your premiums and the smart investment, the conservative investment of these assets by the life insurance companies over time. I mean, these life insurance companies are the most solvent companies in the world historically.
They are.
Right?
It's true.
Yeah. And so we're building around their good behavior.
I was actually just reading the book Too Big to Fail by Andrew Ross Sorkin, and they were apoplectic about AIG just getting one credit rating notch below, because if you're an insurer, right? If you're in the insurance business, you don't get anything but a AAA credit rating, and so that would have been so jarring to the markets, to your point, because I think they've always been rightfully perceived as being pretty prudent with the risk pools that they manage on behalf of their policy owners, et cetera. So I just find all of this incredibly revolutionary and pretty darn exciting, Cole. And so I just want to think through tangibles. So you're buying a policy, and the person on the other end, so we'll say the person's name is Joe. So Joe doesn't want to pay the premiums anymore, but they'll still get some sort of a retained death benefit. So let's use an example, and if you wouldn't mind bearing with me, let's say he had $1 million whole life insurance contract with you, okay? Let's say he paid into the contract for 10 years. He doesn't want to pay into it anymore. You buy it on the primary market through a broker. Then what do you offer back to him in terms of it? Is it a bifurcated death benefit? Is it 750, 500? You don't have to give me exact math, but what does that generally look like for someone that's selling their contract?
Right. It's a good question. So it's actually the measurement. So there's two kind of unit economic measurements within a whole life insurance or universal life insurance contract, permanent life insurance contract. There's the cash surrender value, and there's the face or the death benefit. Now, traditional viaticals or life settlements will price a discount on the face or the death benefit. Okay.
Right.
We don't do that. We offer a rate on the cash surrender value in this case. Okay. So say the cash surrender value, say there's $1 million of face and $100,000 of cash surrender value. We'll give them a plus minus on the $100,000, depending on lots of different variables. So they could get $110,000 for the policy, or they could get $90,000 for the policy. So we're going to write them a check for that. And
on day one, not at death, correct?
Say it again.
At day one, you're writing the check, not at their death.
Day one, right? And now we're moving that from the primary market. Now that's in the secondary market. That policy. So we move that through. There's regulation around that. There's like friction around it, but we have licenses to be able to do that. So we move that through, and now we do an ownership change. We own the policy, and the death benefit doesn't really make any sense. We're not trying to arbitrage their death, and so that we're not perceived as like banking on them dying so we get paid like the life settlement industry is. Mm-hmm. We're not arbitraging their death or arbitraging their life expectancy, right? So what we do is, because it makes us feel good and we're fiduciary, we just give them free life insurance. It's legal to do that. There's nothing really innovative. It happens all the time. It's called retained death benefit. So we fill out a retained death benefit form with a life insurance company, and they keep a certain percentage of the retained death benefit. So they'll get cash from us and free life insurance from us, and then we take over the ownership of the asset. So we can give them, of the $1 million that you described, it's very common for us to give them back $250,000 or $300,000 of life insurance. It's important, right? It's important that people own life insurance. It's just misunderstood. It has this, unfortunately, people think, like, our brains are so broken when it comes to thinking about this, because for a few dollars a month, really, you can own term life insurance, or you can own a scaled down version of permanent life insurance. That when you die, at least your funeral expenses are covered. Maybe some tax expenses are covered. I mean, it's a good thing, you know.
It is a good thing
to do, right? Yeah.
Particularly when young couples come to my office, you know, like often children of my clients, you know, they'll have lots of questions, and I always love talking to young clients. And they usually are really eager to get into the investments because the investments are fun and exciting.
Yeah, they want to buy Tesla and Google. And
You got it. Let's get some NVIDIA in there. They want to go on 10X. I always sort of bore them because I always turn around and I'll say, you know, what do you have at least for some basic term life insurance? Because if, God forbid, the absolute worst happened to you, your wife with your 1-year-old baby could be destitute. And she's making a little bit of income, but if half of the house's income goes away, or in some instances, if all the income goes away, that could be financially ruinsome for so many Americans. And I think we forget the power and the importance of just hedging basic risks, and we don't like to think about death. But I've witnessed several really tragic, very tragic deaths recently in my life. And when there's life insurance, it provides. You think about when people, you know, I watch people come to my office, Cole, and mourn. You know, I watch the suffering of losing a loved one. You know, a spouse that gets dementia and then eventually passes away, and the hurt that they go through. Can you imagine losing someone you love the most, and then you have to deal with financial ruin?
Yeah,
they got enough trauma. Yeah. So by getting basic insurance, what you're able to do is eliminate, in many instances, a lot of the financial stress so that you can actually mourn as an individual, because I think it actually takes away from the human side of being able to mourn when tragedy does strike.
Yeah, that's right. Yeah, it's actually very profound, you know, what you're talking about. And I mean, people that are watching this so when people are in your office and you say that, like what percentage of them get it, or what percentage of them, like, you can see in their eyes they truly believe it, or because they're with their spouse and you paint that picture, do they go, oh yeah, okay, well but you can tell they don't really get it, or they're just, that won't happen to me, or I'm a selfish jerk ultimately at my core, and
That.
I don't care about my wife if I'm dead.
I get to peek into somebody's soul when I ask that question, because good people will look and realize, I love this person so much. Of course, I'm going to provide for them upon my departure. I remember I was a really new advisor, and I was talking to a client about life insurance, and the client literally looked at me and says, but all these costs, I'm going to take it in the chin. And I actually didn't take them on as clients. I was so appalled by the guy. But to answer the question, most of the people that I deal with happen to be wonderful humans. Yeah. So 95% of people, when I explain the ramifications, it clicks instantly. And when it doesn't click instantly for people, it's either that they just don't understand it, or it actually is a little bit of an indication of their selfishness, is the honest truth. So.
And you'd think that, like, do you think that by the time they come into your office and they get in front of you, that are they surprised when you bring up life insurance as part of a financial plan, or yeah. Are they? You'd think that they would be. Are they expecting it? They think, well, they were like, oh, and we were excited to get life insurance to be. No
one's excited about life insurance when they walk into my office.
They're not, are they?
Well, it's not an exciting thing to put away part of your capital towards something that, right? Because for most people, to your point about the lack of literacy around different types of life insurances, different instruments of it, they don't think about it in terms of, they only think of it in terms of the death benefit. And so the idea that they're going to put money aside for a benefit that's going to pay when they're not around is a little bit hard to digest. But that is the premise of using insurance to protect you against a disaster. But once I explain why it's important, and by the way, I have to be careful. I don't want to make broad strokes. Like, life insurance is appropriate for certain people and not for others. That being said, people get it once I explain it to them, because they recognize the importance of it.
Yeah,
for sure.
But
they're surprised. To answer your other question, they're always a little surprised because they view me as stocks and bonds guy, right. And private markets guy. They don't necessarily view, they're expecting me to talk to them about private equity, which we may do, and instead I'm talking to them about life insurance, and all of the above may be important.
One of the so I wear two hats. I wear a tech hat, and then I wear a life insurance. So we're not, like, Infineo is not really obsessed with life insurance. We're obsessed with opportunity, democratization. We're obsessed with making money, but we're also obsessed by making money by making other people money. It's just kind of so we just happen to choose technology, AI and blockchain, because there's great opportunity there. And then we spent a year analyzing what the best real world asset to tokenize is. And we came up with life insurance. So between my personal experience of using life insurance and then coming to this realization that the best blockchain use case for real world asset democratization or tokenization is life insurance, I was having this very holistic kind of entrepreneurial moment where I went, wow, I already believe in that. I already use it. And now I get to move forward. And so it was very, from a founder's story, it was just very natural. But I would, so I wear two hats. I wear a tech hat and I wear an insurance hat now. But it could have been anything. It would, if our research showed us that the right thing to tokenize was real estate, we would have done that. If it was bond portfolios, we would have done that. If it was hotels or REITs, we would have done that. It's just that our research led us to the blockchain use case. AI use case was really, it's mostly blockchain use case, was really around, was life insurance. So I walk into a room, what do? I say life insurance, I clear the room. I walk into a room, people go, what do you do? I say blockchain, I'm really interesting. People are really excited to talk to me. All kinds of questions.
That's great.
Right. And then I live in the Bahamas. And so then they go, oh, did you know, I heard about this guy named Sam Bankman-Fried. I'm like, yeah, that was my neighbor. And then I become really interesting because they want to.
No way.
hear all about him and what that was like to like live in that community while that was all going on. But if I mentioned life insurance, which is of all the thing, which is really the thing, if I'm responsible, the thing I should be talking about is, now when I say life insurance, I don't mean death insurance. I'm talking about the living benefits of life insurance.
That's right.
So,
That's right.
That's always what I'm like. To me, the death benefit is just a bonus. It really, but you use life. So like when I bought this Starbucks here before our meeting today, I literally used a life insurance policy to buy this Starbucks, right? I pay my cell phone bill with my life insurance policy. I bought these earbuds with a life insurance policy, and people are like, "Wow, how do you do that?" Right?
So explain that. Like I'm asking the same. I'm asking the same thing internally. Like, how'd you do that, Cole?
Yeah. So I go out and I get. First off, I went and got a life insurance policy with a big cash component to it. So I did 90 on one of my policies, and they're all built different. I did 90% cash, and then I did 10% net cost of pure insurance. So then I get paid. I get a paycheck. Now I have this life insurance policy. I get a paycheck. Instead of putting that paycheck, say I get a $10,000 paycheck, instead of putting that paycheck into my checking account and drawing down on that checking account to buy my Starbucks, pay my cell phone bill, or buy my earbuds, what I do is I take that $10,000 and I put it into my life insurance policy by way of premium. So I make a premium payment, okay? Mm-hmm. Now, because a lot of that $10,000 is going to the cash component and not to the life insurance, I can go to a bank, for example, like Wells Fargo or Equitable Bank or any of these different banks, and I can get a line of credit against the cash component of that life insurance policy. Banks love lending against this stuff. So now I have a line of credit for $9,000, right? With additional, because I have good credit rating and a high FICO, I could get the whole $10,000 line of credit, really. But let's just say I have $9,000. So now I have a line of credit. Now on that line of credit, I get a debit card tied to that line of credit and a tap. So now what I'm doing is when I pay for my earbuds or buy my Starbucks, I tap that credit card, which draws down on the line of credit, which is tied to the cash surrender value. So my money, but here's the thing, that money,
wild,
right? That's all I do. So that money is still in the life insurance policy. That money is borrowed. So I'm buying this off of money I borrowed from myself, right? From my own policy. So I'm never spending my money. I'm never out of control of my capital. My capital is still in the policy, being paid a dividend of 5%, 6%, 7%, and it's buying me life insurance. So one of my policies that I have is 8 years old. I put $100,000 of premium into it every year. It's with Ameritas. It's in the United States. I put $100,000 of premium into that policy. I can take out every year about $104,000 tax-free, and it's buying me about $6 million of death benefit. So the life insurance is now free. I put $100,000 in, I can take $104,000 out. There's the arbitrage is $4,000 and it's tax-free. So that's pure passive income. This is just how these policies work, right? Now,
this is fascinating.
It was actually what I learned about this idea of infinite banking, right? Mm-hmm. So one of the guys that works at our chief economist, his name's Dr. Robert Murphy. He's written
great guy.
Right. Yeah.
I don't know him, but I think the world of him, and I don't even know him yet.
No, he's a world famous economist. He's our chief. He works at Infineo full time. This is all he does, and he does all of our white papers. He signs off on all of our economic. And so he's written
That's
books.
How I found you, Cole. Sorry to interrupt you. That's how I found you. Is because I was super fascinated by. I was like, because I'm familiar with Dr. Murphy, and I think he's an amazing podcast host and a great economic thinker. And I've been associated with the Mises Institute that he's been involved with.
That's right.
And I was like, what is this guy doing it at, like, he's at like this tech company. Like, what's going on? And then I looked you up and connect with you on LinkedIn.
That's right. And so Bob is the result of a lot of our success. And this is the podcast. I did another podcast earlier today, and it was Bob, and it was because Bob is just like, there's all these, like, I'm a fanboy of Bob. I still am. I still can't believe we managed to recruit Bob.
That's
and
awesome.
He managed to, put everything else in his life aside just for this. But it was, how we recruited this world famous economist was because he just kind of looked at the numbers and the science of what it is we're doing, and he's like, it just makes mathematical sense that somebody at some point in time is going to use this obvious technology with this obvious asset and put the two together and reduce the friction. Because when I describe this Emeritus policy or these equitable policies or any one of my policies, for me to be able to do what I said about, like, for me to be able to buy my Starbucks with my life insurance policy, that's a very complicated thing. Like, it's not an easy thing to do. It's full of friction, and it takes a lot of pain and wherewithal and medical underwriting, and it takes financial underwriting, and you have to apply for lines of credit, and you have to fund the thing for 7 years, and it takes a lot of attrition, to get this thing done. Where with blockchain, and this is what Bob and I agreed on, with blockchain, you can fast forward this whole process exponentially, right? You can, with blockchain and creating a secondary market, I could go in and buy this asset that took me 7 years to kind of create. I could go in and buy something that's already primed and ready to go and functional if I had the capital to do it.
And then you're continuing to fund the policy by year 7. Is that basically the gist of it? So now you're coming in, because I'll say one of my, I would say, pushbacks on infinite banking is because I've looked at insurance policies. I mean, I'm licensed as an insurance agent, and I've looked at them. Is it takes many years for the cash value to actually start to make a positive rate of return because of the upfront life insurance and mortality expenses, right? And so that I was kind of wondering, how do you get around that and make, because I've had clients ask me about infinite banking, and from what I can do personally, there's not really a lot that I could do for somebody like that, because mathematically they're not really making money in many instances until, say, year 7, 8, maybe sometimes year 10. So you're answering a major question I've had today, that you're requiring another policy, and then, as you put it, it's primed. Am I correct on this?
Primed. It's ready, and we see them all the time. There's billions and billions of dollars. So the policy I described, primed, ready to go, year 10, and this thing is juiced. Like, it's just ready. It's
interesting,
right? People are surrendering these all the time because of financial hardship. That's it. They just can't afford them anymore, and they just stop making premium payments on them, or they have life events, but they have nowhere to trade it. All they can do is surrender it back to the life insurance company. It's just really horrible, because they've spent so much time and energy standing up this beautiful asset, and like, I would buy them. I would buy all of those. Why wouldn't you buy those? This is a fixed income alternative. It's better fixed income.
This is very revolutionary.
Yeah.
So let me ask you a question. So we talked I would say a month or so ago, and I think you'd use the word securitization. Mm-hmm. Was there ever, like, you are securitizing in many instances the life insurance market. Yeah. Was there ever any form of securitization that occurred with life insurance before, to your knowledge? And it sounds like no one's done it quite like you have. So talk about the securitization and the creation of potentially a whole new asset class here.
That's what it is. It's a new asset class, and I love the way you put that. That's really intuitive of you to kind of say that, because it's exactly what it is. It's a new asset class. The only securitization of life insurance that exists today and has existed for the last 30 years is the life settlement market. Those are essentially sold as securities. So when there's life settlement dealers and brokers, and what they're doing is they're, companies like Coventry, for example. There's one that just went public recently called Abacus. I forget what their ticker is. They just went public. But that's what these companies do. They basically they securitize these assets.
Are they bundling the assets together as a security and then reselling them to like a pension or a hedge fund?
They are. Yeah, they are. Or the fund is securitizing them. Once the fund gets them, they're securitizing them. At some point in time, they're being securitized. Yeah, it's and they're being rated, and like the whole bit.
It reminds me of asset-backed securities to an extent, right?
That's what it is.
Right? Like if you were to bundle, say, mortgages, or if you were to bundle, auto loans, you're taking a true hard asset and you're bundling it together, and in many instances, is it not pretty similar to asset-backed securitization?
That's what it is. Like, I mean, that's exactly what it is. Really. Okay. It would be no different than mortgage-backed securities. It would be life-backed securities. Essentially, it's just the exact same thing. Yeah. Now we're not. So it's different with us, is that we're not doing We're not securitizing the life expectancy or death expectancy and the arbitrage between what I buy the asset for,
right,
and what the life insurance is, and then when that person dies, what the life insurance company is. So if I buy, so the way that the industry generally works is that if I buy a life insurance, say there's a face or a death benefit for $2 million, and I'm able to buy that policy for $1.5 million, when that life insured dies, the life insurance company is going to pay me $2 million, and I'm going to have a $500,000 gain arbitrage on the asset. So, I mean, the problem is that if the person lives, and people are living longer and longer all the time. This is one of the big issues with defined benefit pensions and defined contribution.
Social Security.
Social Security is living long is becoming very popular. People are living long. People are living longer than they're supposed to, and there's a lot of downward pressure on the securitization of these life settlements because they're often shopping them to be reinsured again because they're outliving the underwriting of them. Now that becomes a risk on their balance sheet because there's no positive arbitrage anymore. So the whole thing is a mess to me. Like, it's just you're banking on people dying. How do you sell that? Retail will never understand that. It's very morbid and very controversial. So, I mean that, like, I understand it, and I see quite a lot of value in it, because if I'm an elderly person and I realize I only have 5 years to die and the only asset I have left is a life insurance policy and I need that money to live on, I'd be quite happy. So a lot of these life settlement companies like Coventry and Abacus, they're actually doing a lot of very good work. A lot of people think that they're opportunistic. They're not. They're actually good people doing good things for people because they're actually providing liquidity for these people later in life so they can have some money to enjoy their life, pay medical bills, go on a trip maybe, right? So it's not a bad thing. It's just a lot of retail and end users or media love to lump it in as something bad because you're
misunderstood. I think it's misunderstood, and that's what you're trying to say.
Yeah.
I mean, look, I'm licensed as a life insurance agent, and it took me a little time to get my head around what you're actually doing. So if it took me a little bit of work to figure it out and to research it, and then, I mean, just live during this conversation, you've really unlocked a lot of questions that I had because I really wanted to get my head around this. I've worked in the financial industry for over a decade. So if I had to work for it, there's going to be some, I guess, intellectual barriers to entry for your typical retail investor. But I think one of the things you probably should remain hopeful about, Cole, is that there can be a burgeoning market, whereas institutional investors see maybe some opportunity here. Maybe in time what happens is then the retail investors start to realize that there could potentially be an opportunity for them as well. There just is probably going to be a bit of a life cycle, don't you think?
Oh, by 2030, the security token market cap is predicted to be between 16 to 30 trillion dollars. That's not far away. So right now, today, as we speak, in early June 2024, we're early. We're very, very early. A year, 2 years, and again, Larry Fink and BlackRock have single-handedly taken it on as a personal responsibility to push this narrative and to push this market cap into reality. So it's happening. They are doing it. Their IBIT spot Bitcoin ETF outperformed GLD by 55% in the first 90 days. The BITL fixed income bond fund on Ethereum at $100 million has outperformed most analog fixed income funds. And I mean, so these are two digital asset funds that BlackRock has stood up that are revolutionizing the industry. I mean, the sales and the percent change, the market cap in these is just completely unprecedented. So I mean, Bitcoin, the spot Bitcoin ETF IBIT issued by BlackRock is it has outperformed gold the very first ever gold ETF, which was in 2004, by 60% in the first 90 days. So it's to your point, it's coming, right? Digital securities, digital assets will be $16 to $30 trillion in 8 to 9 years. So, yeah.
I mean, the financial innovation that's occurring is rapid and ever-changing, and I'm excited. I think it's an exciting time to be able. There's a lot of negativity out there, but I think this is stuff to be excited about, and just in the way that investors, will likely have access to greater products. I can't even, sell most of these types of instruments yet. Maybe one day, but it's just exciting to see the changes that are happening. That there's new innovations. How do you think this changes? Do you think what you're doing could fundamentally disrupt the life insurance markets, or even the regular markets, the equity markets, or fixed income markets? How is this going to change the dynamic when it comes to the financial markets, Cole?
I think as far as the life insurance agencies, I mean, initially we have been we have made the life insurance industry uncomfortable, I would say, which is great. I mean, if we weren't making the life insurance industry uncomfortable, we would not. We're on their radar. They know who we are. We are. They're watching us very, very closely, and we love it. There is nothing that we do that is uncompliant. Everything that we do is in the daylight. There's nothing that we do that hasn't been on the right side of regulation. Even when I founded this business over 2 years ago, and when there was a lot of lawyers, so our lawyers are at Perkins Coie and DLA Piper, just in North America. So we deal with the best of the best, the biggest of the big. Deloitte are our accountants, New York City, and when we went to organizations like this and explained to them what we were doing and that we needed audited, we needed letters, the first thing I did not ask our lawyers for was what's called a letter of no action. And a letter of no action would suggest to the SEC that the thing that we're trying to stand up is not a security. And 2 years ago in digital assets, that was a very common maneuver, was to establish your security not as a security. So the common assessment for a security is something called the Howey test. I looked at fractionalization and tokenization of life insurance, and I instantly said, this is a security. Why would I, even though life insurance in its pure non-fractionalized form is actually not a security, it's a commodity.
That is correct.
Right? But when you fractionalize it, it doesn't satisfy Howey, and it becomes a security. Now, I could have went to our lawyers at DLA Piper or Perkins Coie and said, guys, I need a letter that you're going to write to the SEC. Explain. I said, no. I said, I'm coming to you. We're standing up a security. That was so refreshing for them. That's how, as a digital asset or a crypto project, we were able to attract DLA Piper, Perkins Coie, and Deloitte New York City as our service providers, because they respected the fact that we were doing everything in the daylight, and we just said we're going to comply. We're going to register with exemption Reg D 506C with the SEC. We're going to raise money and distribute, originate and distribute the asset through that exemption, and just be completely in the daylight. And at the time, that was completely revolutionary. 2 years later, today, there's ATSs, there's broker dealers, there's transfer agents, all built in and around securitization and digitalization of real-world assets. And these companies are like, well, Securitize is by far the biggest right now. That's who BlackRock works with. KKR, I think, work also on Securitize. Most of Securitize has kind of won the day, but there's INX, there's Oasis Pro Markets. I mean, it goes all transfer agent, broker dealer, and ATS licenses. So,
well, there's so much controversy even just a couple of years ago about is Bitcoin or Ethereum or these other cryptocurrencies, are they a security? And kind of everyone was putting themselves in a pretzel. There were lots of questions of, is it taxed at long-term cap gains rates or short-term cap gains rates? What is it actually? Is it a currency? Is it a commodity? Is it a security?
Yeah.
And I find you as you were saying that, literally the word that came to mind for me is like, this is just kind of refreshing. Like, in some senses, Cole, it feels like you're just keeping it simple. Like, let's face it, what you're doing, and we talked about it earlier, is you're packaging real-world assets in a securitized fashion. You might as well just call a spade and let's move on and make this easy. And I think you're also preventing scrutiny when you're just like, hey, listen, we're here. We want to be regulated. We want to follow the rules. We want to be fair, and we want to be honest. And so I commend you, Cole. I think that's awesome. I love it.
Yeah, great. Well, I appreciate it. And it was it never crossed our mind to be anything just other. Our core values in our company are FIT, first principles, integrity, and transparency. And when we stood Infineo up, that was the first thing we did. Is we set a trio of core values. And if we're a security, we're a security. There's nothing wrong with being a security. I mean, it's actually a good thing. It's the word security is. I mean, many psychologists will tell you what does the human brain need. The human brain needs security. The human brain needs certainty, right? This is, and then so the securities are fundamentally designed to protect, end users at the end of I don't think that's a bad thing.
I mean, I broker securities, so I mean, I'm picking up what you're putting down, brother, and I like it.
Yeah.
If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com, or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.